Well, I can't say I didn't warn you guys. Today we had the Fed come out and raise interest rates by 75 basis points, and the market has significantly rallied. A lot of people have been caught off guard by this, but I did predict this about a month ago, and I've been saying this, that leading indicators are showing us that inflation's starting to peak, and that at some point the stock market is going to completely stop reacting to all the bad news that so many people have been talking about. As you can see, just today, my portfolio performed quite well, even though many people would have expected after the disaster earnings we saw from Alphabet and Microsoft yesterday that the market would probably be down, and with the FOMC rate hike, the market would have gone down even more. But as you can see today, not even considering the action we're seeing in after hours right now, with STEM, Plug Power, and Bloom Energy actually up very significantly due to a very nice Senator Manchin bill coming out for climate, the market is still up. And as you can see, this has been a trend for the past couple of weeks. Now, is this the bottom? Nobody really knows. But my job is not to predict the bottom. I've said this multiple times. My job is simply to buy during times of fear. And if you don't think that a 30% decline in the NASDAQ is a fearful market, then you're completely wrong, because we've rarely seen this happen over the past 20 years. And a lot of the people that are actually making these predictions on Twitter have not even been in the market or probably even alive for the past 20 years, which is extremely funny. But regardless, let's actually understand what the Fed has done and why the market has stopped reacting to this somewhat bad news. Well, the simple reason for that is because 75 basis points has already been priced in by the market, given the fact that core PCE data has already peaked. I've said this multiple times, but the data that many people rely on right now in the media and in the community forums in the retail investor side is CPI, which is driven by oil. But core PCE, which is driven by actual commodities and some of the data that consumers use, has actually been going down. And as you can see, we already peaked back in February 2022. And this is obviously a leading indicator because CPI tends to follow oil much more. And so if inflation has been the main reason why the Fed has been increasing interest rates, and inflation as a result is going to be the main thing that's going to result in the market bottoming, then this is already a sign of the market having bottomed. I just feel like many people are not understanding this, and many people still think we're in this bull trap kind of phase. Now, I'm not going to make a prediction as to whether or not we're in that phase, because it is absolutely impossible for anyone to know what is going to happen. All I want to do is I want to buy when many people are selling and when the consensus sentiment is to the downside. And if you read the comment section on this specific tweet, you can see that many people are actually thinking we are in this fearful and return to normal phase. And if you can see, return to normal essentially is like the peak of this bull trap. And the reality is that most of these people will continue to think this all the way until the market hits all-time highs. And at that point, they will flip bullish. And that starts the same cycle that we saw in 2020 and 2021. So the bottom line for me is I'm going to continue to buy the dip. I do not care what the macroeconomic situation looks like. I just made a little bit of a prediction a month ago about what's going to happen with the market because of some of the leading indicators I was seeing in something like the XPEV index, which is obviously a risk asset. And when this has bottomed, it's very easy for us to see that the general market might also be bottoming in the very short term. Now, sure, the Ukraine war could get a lot worse. We could all of a sudden see a new variant of COVID come out, and that could result in another crash in the market. But given the catalysts we have right now, which are essentially the catalysts we've been worrying about for the past a year and a half, which is inflation, interest rates, and obviously COVID, I don't think the market cares about that anymore. At some point, it's going to stop reacting, and those are exactly the times that you want to stop buying the dip. But right now, that is not one of those times because the market is still somewhat reacting to those. And at some point, we will reach all-time highs. And at that point, maybe you want to cool down with the amount of money you're putting into the market. But as of right now, I see a good opportunity to buy, even though, yes, we have rallied a little bit off the lows. And one of the big reasons for that is because, as you can see right now, the decline in the NASDAQ and the Russell 2000 is still extremely significant. We're down like 30-35% on both of these indices, which are essentially the growth stock and small cap indices. If you want to build a wealth, I am personally investing in NASDAQ and Russell 2000 stocks. I'm not actually investing in any large caps or blue chips for a significant part of my portfolio, right? Because those stocks like Meta, Apple, Microsoft, Amazon, those companies are for wealth preservation. I'm looking to build my wealth, not necessarily preserve my wealth. So I'm going to be taking more risk by investing in some of the higher risk companies in the NASDAQ and Russell 2000, which have more growth ahead of them, but also they're unprofitable. And that's why they're the first ones to be sold off in a low risk environment. But obviously right now we're starting to see a risk on rally in the stock market. And I think that could result in these specific sectoral stocks outperforming the rest. That is exactly what we saw with the XPI index. Another key thing many people tend to overlook is the fact that because of the rising prices in houses, we're starting to see affordability reach all-time lows. People have obviously stopped spending money because rents have gone up, inflation has gone up, and the cost of living, generally speaking, has gone up. And as you can see, last time we saw this happen was right before 2007. And if you remember, 2008, 2009 was a period of deflation, not inflation. So the key thing to keep in mind is that every inflationary period is followed by a deflationary period. And so chances are the Fed's work of 75 basis points is not going to immediately calm down inflation within the next 2 weeks. That's not how this works. It's going to take at least 6 months to a year for the effects to take place. And like I've said many times in the past, the stock market is a forward-looking indicator. So it does not care what the Fed is doing right now, because a lot of people have already been talking about this event happening for the past year or so. Secondly, as you can see right now, the Fed funds rate is going to be in around the 2 to 2.5% range within the next year or so. And as you can see, over the long term, there's very little correlation in what the Fed's funds rate is and what the stock market does. And historically, whenever we have seen these hikes, the market tends to actually rally. You can see from 2004 to 2007, which is when interest rates were actually being increased, the market clearly rallied, right? And then interest rates were cut in the recession. Same thing happened from 2015 to 2019. You can look at the S&P 500. The S&P 500 rallied from 2015 to 2019. And so a lot of the arguments about higher interest rates being bad for stocks is not actually true in the long run. And that is exactly the same thing we're seeing right now. The only difference being that right now, the interest rate hike is a lot more aggressive. And that's why the stock market sold off so aggressively. And every piece of aggression results in a quick bounce back. And that is exactly why you want to be taking advantage of some of the deals we're seeing in the market. And obviously you want to buy the right companies. You don't want to buy any company out there because some companies might not recover. But if you're diversifying your portfolio properly, and if you're investing in companies in which you have an edge, meaning you're investing in companies that either have good fundamentals or that you have a very good understanding of the business or the technology, then you can't really do wrong buying in this kind of fearful environment. And as you can see, that is being represented very clearly by the number of companies that are trading below their cash and short-term investment position. Guys, this is a very underrated chart in my opinion. This literally shows you that because of the massive influx of capital we saw in both the private and the public markets throughout 2020 and 2021, a lot of companies' fundamentals are fantastic right now. Even a lot of the small cap companies, even something like Meta, which has been getting absolutely shit on over the past 2 days, especially with the earnings report, has not actually gone down in after hours after they reported earnings. If these companies have stopped reacting to all this bad news and bad earnings coming out, you know that we're very close to the bottom. Even Alphabet and Microsoft didn't go down that much after hours, even after they missed earnings. And people are very surprised by that. And when people are surprised, you know that most of the crowd is sitting on the wrong side of the boat. And because of just the amount of companies that are trading undervalued with their cash and short-term investments well underneath or well above their market caps, this is a pretty rare opportunity to buy stocks, especially if you know what you're doing. We haven't seen this environment since 2008 and even 2001. And this is actually a significantly worse environment. But obviously we know that from an economic standpoint, we're not actually going to a real recession where people are losing jobs. The only recession we're going to see is a paper recession, which is obviously what the Fed is creating. And that is actually something the Fed actually wants to see. You see, a recession is a decline in GDP. A decline in GDP means aggregate demand is falling. Aggregate demand falling means the supply and demand balance is going to equal itself out. The supply and demand balance equaling itself out means inflation is going to start easing. So even if you want to look at the CPI data, which is going to lag the core PCE data, inflation's likely going to be easing in the next 12 months, even though right now it seems like it's not, and that the Fed's actions are not taking place. And that's probably a reason why the Fed has its projections to actually cut interest rates in 2023. And we all know what happens to stocks when interest rates are cut. But as usual, guys, let me know down in the comment section below what you guys' thoughts are on all this drama that's going on in the market. I'm going to make a video about some of the new updates with the clean energy bill and what's going on in that sector. I think it's a very exciting opportunity to be investing in clean energy, and some of the action we're seeing in after hours with STEM, Plug Power, Boom Energy going up really validates that thesis. But as usual, guys, I'll catch you guys in the next one. Take care.